Okay, this is a video on how to update what Maggie calls the accumulation distribution and also the gambler's count. And the first thing, I'm going to scroll down here, that's the heading that I wanted to show you, but she breaks it down by month. For some reason she writes it here instead of right there where it's right above it. That kind of makes more sense to me. I haven't changed it yet on mine. But we're in September. The first thing that we enter is the accumulation distribution grades. This is something that investors.com, which is Investors Business Daily, has as a proprietary formula to measure whether specifically the institutions are doing more buying or selling at the moment. So the first thing you need to do is go to investors.com. If you don't have a subscription, it's IBD Digital is what you need. You can go to the store to buy that. Once you're here, you're going to click on Market Trend, and then if you're on your phone or your iPad, you got to click on the word Market Trend here again to get this page to show up. The first thing you'll notice is it'll either say uptrend under pressure, or downtrend. I don't know if it says downtrend under pressure or not, because downtrends usually don't happen as long as uptrends. But you'll see this graph, and then either in the morning, anytime during the day until the market closes, or about 5 or 6 o'clock, basically 2 hours after the market closes that day, you'll be able to see that day's chart by clicking this blue button. And you'll want to check and see which day you're on. Thursday, September 17th happens to be today, but if you check it too soon or too late, it might be the wrong day on you, and unfortunately there is not really any way to come back and check this again. But the letter grade here is what you're looking for. So it's A through D, and then there's A plus, A minus for each one. A means there's a lot of buying by the institutions. E means there's a lot of selling from the institutions. So we're just going to take this letter grade here for the S&P 500. So you see this first chart is for the S&P 500. We're looking for the D minus, and then this is the percentage move for the day here. So we're going to need both of those numbers. Going to go back in and type that in. So it's a D minus, and then a negative 0.8. Oops. And then I'm just going to click off that. Oop. I messed it up by turning it into a formula. I think I just did it again. So what I'm going to do here is click the green checkbox to fix that. I'm going to start swiping between the apps here instead of clicking. The next one is the NASDAQ Composite. So we have a negative 1.3 and a D. So D is actually up half a letter grade from where it was yesterday. Then I think I said, I know it's negative, I forgot what it is now. 1.3. So negative 1.3. And click the green check just in case. Now the last one is IWM. That is actually a Russell ETF for the Russell 2000, which is industrial stocks. I'm going to go ahead and click the back arrow. Come back here to the ticker keyword. Type in IWM. Click on return or enter. And I'm going to scroll down here. So you're going to make sure it says iShares Russell 2000 ETF. And then you're going to look for the grade here under ACC/DIS, accumulation distribution. And you're going to put that in. I literally didn't pay attention to what it is. So D plus. And that is that. The other thing that you would update every day here is what she calls the gambler's count. She calls it that because it's a term for counting cards. And it's not really used that way, but it's basically just a way of seeing if there's a possibility that the market could have a downturn when it's in a pretty aggressive uptrend. So you're going to click on stock lists, and then you're going to hover over IBD data tables and click on that. And then you're going to go down here to the new high list and click on that. I do have to caution you, under research or stock list, there is one that says new highs. That's not the right place. So then we go and we're going to add up these three numbers. So let me get my thing here. And see if I can do this. So I'm just going to add in. That's a little annoying. Hold on. There was a way to change how big this is. Don't remember how. I'll have to fix that first. You know what? I'm just going to add this on my phone and tell you what the number is. Probably should have just added it in my head, but anyways, I want to be right. 27 plus 39 plus 6. So the total for what happened in the New York Stock Exchange, the NASDAQ, and the AMEX is a grand total of 72 new highs for the day. So we're going to type that in here under highs. Then we're going to go back to that same table with our calculator and add that up for the lows. And that's 27. So we're going to put that in. Now, the way that this information is relevant, by the way, these two columns are something she uses, but I don't. It's part of the whole gambler's count thing that I don't really count cards like she does. Anyways, when you're seeing weeks like this, where there's 300 new highs and only 7 new lows, 21 lows, and so it's like probably an average of 15 or so, then whenever that average doubles and you see something in the 30s when it was back in the 15s, that usually happens right before a crash in the market. When I say crash, I mean a pretty big pullback or something that like what you saw in COVID. So just going in on a chart here. Let's go back to your chart and show you what happened. So she noticed, let me pull it back up. She noticed back on Monday, August 24th, the number got a lot higher than it was before. And so what you do at that point is you just keep an eye out for something that looks like a very big day happening of down volume. So on August 24th here, sorry I'm jerking you guys around a bit. I can't get it to show up with my mouse, so I'm going to do it with my finger. On August 24th, you can see it was up. And it was up for an entire week after that. And that day was nothing really notable. I mean, it might have been enough to get you to want to get out of your trades, but then you'd be sad you missed the last 2 days. But then on that Thursday, you would have been really happy you got out of anything that was an upward trade. because the entire market, just about every stock in the market, went down for 3 days straight. And so there's been many times where that new high, new low count is kind of shown about 10 days or a week, even a week and a half. Well, 10 days is a week and a half before it happened. So you can see Thursday the 3rd was the day it happened. There's no new highs and a lot of new lows. And then the Friday after was even worse. Then the Tuesday after the holiday, it continued, and now it's just kind of been sideways. So that's 1, 2, 3, 4, 5, 6, 7, 8 trading days in advance that you were warned, and you would have been out Tuesday and Wednesday of that week from trading if you would have followed that here on the 30th, I believe. That would put you, I think your days are wrong here. It's possible your days might be wrong here, but either way. So that is the gambler's count and the accumulation distribution. This over here is for you to practice guessing which way the market's going to go when it first opens. What you're looking for is a gap up. Well, actually, I could show you there. A gap up is where, this is not really the charts I like looking at for actually looking at charts that much because it's harder for me to see. But a gap up is where it closes up here and then it opens higher. I'm trying to find one. Here's a small gap up. So it closed right here where the top of the green box is. And then you can see that one is a little bit higher for the lowest it was. That was because it jumped up. The gap down is just the opposite. It goes down. Like I said, these charts are kind of hard to see. If I go into Thinkorswim here, it's a little bit easier to see them. Let me see if I can find one. Here we go. This is a pretty obvious gap down. That's a pretty obvious gap up. So that's what you're looking for with the gap ups and the gap downs. But to kind of explain what you're looking for with the up versus prior, I use Yahoo Finance for this. I don't use a chart. I look at these in the pre-market. So there's a thing for post-market and pre-market where the normal retail traders can't do any trades, but banks and institutions can if they want to. So if you see this as a negative number right before the market opens, then it's pretty simple. You just put it in your journal that it's down. If you see, if you see it's a positive number like this, then you know it's up. Because this number is updated moment by moment even while the market's closed on Yahoo Finance. That's why I like using the Yahoo Finance app to do this. And I also like it for the watch list because you can see your individual stocks if it's up after hours or down after hours. And so if you see a lot of your stocks are down after hours the night before, and then the morning before the market opens, you check it like 10 minutes or less before the market opens. It disappears the second the market opens. But if you check it 10 minutes before the market opens and you see all your positions are pretty green, you know the market's at least going to jump up in the air as it opens. It might go right back down, or it might continue going higher, or it might just stay where it is. You have no idea what happens after that without kind of watching it play out. But it gives you a really good idea what's going to happen in the first 10 minutes. If you see all of this in red or all in green, Maggie actually uses canary stocks to measure that. She measures it a different way, but basically the way I use it is I added she had 15, I have 14. Took one of them out. But she looks at all these industry leaders in different sectors of the market and looks to see how many of them are up versus how many of them are down to kind of get a feel for what's going to happen uh, that same trading day. So she'll go in and do that in the mornings. I'll just take a glance at it, and if I see them all uh, red or all green in the post or the pre, I know pretty much what's going to happen from there. So the AM action is by like 9:30, 10 o'clock. Has the market gone up, down, or sideways? Basically sideways down or sideways up. And then the close of the day is a prediction of where the market's going to end for the day on the SPY. I do it by the SPX, which is this right here. The SPY is an ETF of the S&P 500. The SPX is the actual index itself that's tradable. This is way cheaper. So you can see this is $335, where this is $3,350. So it's just 10 times more. But the market does its absolute best, or the SPY does its absolute best to match the SPX index. So there's really no appreciable difference. I think that's everything. So I'm going to go ahead and end it there.